much. And thank you for my additional degree. I've been lucky enough to work for Dr. Roubini for about 6 years now, and I like to think I've been lucky enough to work for a brilliant man and get the equivalent of many of the positive things you get from even deeper academic training while being paid to do it, and meet with people like yourselves and really understand the political economy. I should just begin by thanking all of you, thanking the organizers and the ministers for the introduction or the invitation, and it's a pleasure to be with you again. To the remarks, am I here to predict the next crisis? I think we're still facing the aftershocks of the first crisis. We've seen a wave of continued crisis related to over-leverage, particularly in developed markets, in Europe, in the US, and they're all elements of the same cycle, which will lead us to slower global growth. And that puts more pressure, but also more opportunity for countries in the Black Sea region. We will be digging in more detail, but what I'm going to do in my 8 or 9 minutes is to situate the Black Sea in the global economy. Others on this panel will dig more into the individual situation. And what I really want to do is focus out to the long term, which I think came out very much from the first panel of today, the importance for the investors of clear policy paths for the long term, policy certainty, because the sorts of economic and investment opportunities we're talking about today are not for the short term, they are for the long term. Last year, when I spoke here, I talked about the perfect storm. This was a possible disorderly event in Europe that could lead to a global credit crunch, fiscal cliff, and policy gridlock in the US, which could continue to hit what's already a weak economy, a risk of an infrastructure and investment collapse in China, and increasingly rising tensions in the Middle East that could lead to military conflict. I should say all of these are tail risks. The worst case version of all of these is unlikely to come to pass, but many of these risks still loom out there in the global economy, and those put risks for countries in the region. The good news, though, and this is perhaps a bit of a change from this time last year, is that a lot of the policymakers are aware of these risks. And we've seen, particularly in the Eurozone, a willingness as policymakers looked into the cliff and saw how bad things could be to start to take some actions. Now, the coming actions are going to be more difficult. And so I would say that we haven't seen the end of the financial risks. And when you look at it, and this is particularly important for this region, what's ultimately important is how strong is growth going to be? How strong is demand going to be in these very strong pillars of global growth? Thanks. And I want to dwell into particularly what this means for the region. I've replicated here our latest forecasts for global growth. You probably can't read them here. If anyone is particularly interested, grab me at the break and I'm happy to send you these or our recent work. But just to say, the numbers are not very strong. We're expecting global growth of around 3% this year and next year. To put that in context, the IMF used to call global growth of 3% a global recession. How times and definitions have changed. The positive news is, of course, emerging markets and frontier markets, like many in the region, are going to grow more strongly. The negative side of the story is that many of the countries in the Black Sea region, most notably countries like Turkey, also Ukraine, also Bulgaria, are facing significant slowdowns in growth, like some other emerging markets, because of some of their balance sheet vulnerabilities. Now that's the short term. The long term, the issue right now is not only how policymakers in Europe, but also how policymakers in the region use the time that they've been bought with all of the liquidity and stimulus that's been pumped into the global economy. So I'm going to run through the text and just show you the pictures, which I think are more useful. So, just to sort of look out on growth prospects on the region, which I know that other panels will be talking about, we see an environment where almost all the economies in the region, particularly those in emerging Europe, are going to see growth below trend. That trend that has a lot to do with the reduction in long-term capital inflows. But it also has a lot to do with the fact that these countries are still reliant on exports, particularly of commodities and services. All of these areas that we heard people talking about increasing, we're operating in a new world economy where underlying demand is weaker. I've replicated here, very unclearly, unfortunately, the leading indicators in some of the big polls of global growth. They're not very encouraging. They point to, at best, relatively flat growth, continued expansion at the current pace, and at worst, a bit more of a downturn. So that means, as we heard this morning, that in the competition for global capital, countries in the region really have to take steps to differentiate themselves, to point to areas where they're improving, to improve the balance sheets, and to make the sort of longer-term policy changes that attract capital. The good news is that some of the vulnerabilities that left countries exposed during the first waves of crisis, the US-led crisis in 2008, the European-led crisis of the last few years, some of those vulnerabilities have been reduced. Countries like Bulgaria, for example, have reduced some of the foreign currency debt that they have on their balance sheet. This leaves them able to respond in a more meaningful way. The central banks are starting to act somewhat more proactively, and across most of the region, easing inflation provides a bit more space for the central banks to support economic conditions. But the fiscal side is equally important. So this, as we see, there have been improvements in some of the debt positions across countries in the region, and also some of the Eastern European countries, which are seen in many cases as competitors for investment dollars. But I want to turn my attention to the medium term, because I think that's many of you here that are investors or are looking for long-term investment to help support growth. What I've represented here are some results from a proprietary country risk model that Roubini Global Economics has, which looks at the strengths and vulnerabilities of different countries. It's ranked on a 0 to 10 scale, and it shows that the Black Sea region has some common strengths compared to key emerging markets. It also shows that it has some common areas of weakness. Those in particular areas of weakness tend to be on the business environment, an area which is improving, but from a low base in many cases, particularly in Russia and Ukraine, but it's a common trend across parts of the region. I should say everything that I highlight as a vulnerability is actually an opportunity for improvement, in contrast to some of the other countries. But we also see strengths include the fact that poverty levels have decreased and are much lower. That's testament to social policy in many countries. And then we also see some improvement, some space to, in some cases, take on more debt or not have to deal with excessive debt burdens going forward. I've included Greece here on the table, which, as you notice, has an awful lot of red, not just pink, which I've highlighted as vulnerabilities in the Black Sea region, but outright red. And obviously, the economics flexibility as well as the debt burdens in Greece, we read about in the papers every day. What I think is, what stands out to me on this is that there's been improvement in some of these indicators over the last couple of years as countries have responded to the financial crisis, but there's still a lot of room for improvement. And particularly on the policy stability and predictability side. Let's see. Oh, there we go. So in this slide, because I know the slide I showed you was a little bit small and hard to read, I wanted to just summarize the takeaways from what the model is telling us, and also put in context. What I said on the stagnation of business environment is not alone to the countries in the region. It's actually been a general trend across emerging markets. There was a period of tremendous economic reforms early in the 2000s, and then since then, with some exceptions, including of some countries in the region, structural reforms have relatively been on hold as countries work towards economic stability and stabilization, responding to short-term crises. But given the story I depicted, the best case scenario is for weaker growth going forward in the global economy. So this is the time for structural reforms, which increase resiliency to future shocks, because I don't think we've seen the last wave of crisis out of the global economy, and also increase potential growth. Among the areas targeted include increasing the flexibility of the economy, investing more in innovation, investing more in education. These are not short-term solutions. One thing that stands out is that infrastructure is okay. And it's very good in terms of telecoms on a global level and for the levels of per capita GDP. But transportation and utilities infrastructure across the region still have room to improve. Now that's an opportunity for those who are willing to invest. The region is divided by its demographic endowments. We know Turkey, for example, has a very strong young sort of population. So do some of the other countries in the region. Others, including Ukraine and Russia and the Eastern European countries, have more adverse demographics and even more need to increase productivity. But even the countries that have strong demographics can't escape doing economic reforms. Having said a lot of negative things along the way, I wanted to sort of end with some of the areas based on this analysis and our macro and institutional analysis. What are the positives? What are the areas for growth? Many of these are themes we'll be talking about in the rest of the conference. In particular, opportunities, we see opportunities in agriculture as productivity is increased and as new reforms are enacted. As mentioned, there's space for infrastructure improvement, which will cause other positive spillovers. There is space for convergence and catch up with advanced economies and trying to do it better than some of these countries did, looking for models among developed markets, levels of development that did it in a more balanced way. Increasing interregional trade will be potentially another area of support. And finally, as mentioned, focusing on increasing flexibility and innovation in the economy. Thank you very much.